Hello, welcome everyone. I thought I'd share a quick note that I get from time to time clients, how they use the indicators and what they think of them, rather than hearing from an individual who created them and telling you how good they are. I thought it'd be interesting to at least share this from one of our students slash members slash good acquaintance. So Jim, you sent this email in, and yes, while I never take offense to your bottom line um, comment about what moving average you use, I just think it's interesting of how you combine other tools with my work. So first and foremost, I've never been one to say abandon everything else you feel comfortable with what you know, what gives you the confidence to pull a trigger to get into a trade. Remember, I can create the best indicators in the world, but if someone doesn't use proper risk management, if they don't execute the trade and they don't exit the trade properly, they're not going to make money. So I just wanted to make sure that you understand that trading is a little bit more than just indicators out there. The best indicators, they do a great job, but I think some indicators right now are better than others. And the point of this video is to share with you what exactly is Jim talking about here. And I'll keep his last name anonymous, but he says, John, I continue to marvel at the accuracy of the JP volume indicator. Just to ask yourself the two lines above below, combine that with price, daily, pivot, blue, and you have the direction of the market. So in any event, this is a 30-minute chart of the diamonds, and he prefers the diamonds over the spies. All right, so what is he referring to here? And what he's referencing is some of our work and what we did in the live trading room, as well as looking at the work that we've been prognosticating ahead of time with this market. This is the JP volume indicator, and what I've done in the background is I teed up the same chart, same time frame with a couple different indicators to give you an idea of what the differences are between any typical volume indicator. So first you see this is the Dow, the diamonds that is. It's a 30-minute chart, and it dates back from 2.7 all the way to 2.26. So Jim, thank you, and it looks like you've had some very successful trades as you were talking about here, and thank you, and I appreciate that. All right, next, let's talk about what the best thing about my indicator is. It's a volume indicator, and it's found exclusively with TradeStation. I have not issued this, licensed this out anywhere. It's not on Thinkorswim. It's not anywhere other than TradeStation. And why did I create this? There's a couple tools that I have that are exclusive with TradeStation, and there's, again, every different formula with my PPS indicator has some variant differences within TradeStation and, again, Thinkorswim. But most importantly, what I wanted to share with you is if you take a look at on balance volume, which many of you know that I helped popularize back in the late, 2008, 9, 10 era, and we created a different volume indicator because something was amiss. And if you notice here, the first thing that's very, I guess, obvious that pops off of the chart is that from this number one high that the market had back on February, let's call it the 5th, what it is, there it is, or the 6th, excuse me. So if you take a look at the high that occurred here, we did run up on decent volume, as my volume indicator says. Now, my volume indicator is also, it measures volume in terms of percent change as well as the momentum of that percent change. It's a zero-line histogram, so as well. So there's a couple functions that it does. It points out, and this is the number one issue that I wanted to explain, divergences. Bullish convergence or positive convergence, and negative or bearish divergence. And what does that mean? When a price of a product goes up, most people now are looking at whether or not volume is associated or moving in the trend direction of that move. And what we found in the last, say, 8 years, and why I created this, was I wanted to smooth out that volume because I was starting to notice that the on-balance volume, which is better than volume histogram, but it was losing its effectiveness at times. And one of the times it was losing effectiveness was watching it make newer highs, giving people a false sense of security that upward price pressure was accompanied by positive volume readings. And if you look here, our volume indicator said, no. It is making weaker volume changes because we are making lower histogram highs as price is making a newer high. That, my friends, is bearish divergence. And that's what I believe Jim was referencing. He's amazed at how efficient this tool really is. And that's why I wanted to stress, in our live trading room, we don't just put our money where our mouth is. We're live trading. We also have a strategy trade station performance with our trade manager in front of everybody with real trades. And then most importantly, these are kind of like some of the with the SPY, SPXL, these are daily and 60-minute and VXX, some of the instruments that I use in J-Person Asset Management. So the tools that we have, if you'll notice here, it's pretty interesting that why do I not have any other volume tool when I have my algo room up? And this is from our live trading room, because I find that the volume indicator is more efficient in detecting true market conditions. Now, today's action, we had just an insane wild volatility, if you see down here in the 15-minute with the Fed announcement. And then as the market started to pull back, look at the volume histogram. It was suggesting that this market was in deep turmoil, and again, it was. Also, notice that in the VXX on a daily chart, we started to see an accumulation in a breakout mode supporting upside movement. Now, this is another one of our market, which today, again, we had another fabulous day for our algo position. This is the gold model, and I just wanted to share with you what this strategy does. First off, in our live trading room, you'll see there's no trades here. Why? Because it only trades from certain times of the day, and we block it off. And I'll share this strategy in just a second. The focus here is the volume indicator, and you'll notice that as the trend of the price is moving, what is the volume indicator showing you? It was moving up, it pulled back, and then it started to show right at the precise time we were generating buy signals. And if you're familiar with TradeStation, you know that when you get into a positive trade, at least a good trade, this went short and immediately got stopped out. This went long, and basically it scales out of half the position is what this model does, and it trails a stop on a balance. And you'll notice here we had another trade over here. It made money. So the blue is positive, red dashed lines are negative. This is a trade. It went short. It got out of half the position, and then you see these yellow hash marks. Those are the trailing stops that get that alert you on the chart where the new stop is. So every time the market moves in your favor, a new stop function kicks in. So this was our gold model. But one of the neat things about this is if you're looking at a long position here and you go, I don't know, that's kind of iffy, because the volume, while the momentum was picking up, it's an iffy trade, right? Because the overall trend of the volume was fading as the trend was rising, which was suggesting that gold was possibly running out of steam. So by the time it generates a short trade here, look at the volume histogram. It's already in negative red mode. So this is a kind of an indicator that helps you to support, hey, if I get short this market, am I getting short with the right type of volume trend? And that's one of the main reasons that I put this particular indicator up in our live trade room for our traders. Now, let's take a look at another market, crude oil. Not really associated much with gold. In fact, it had the complete opposite effect, but you can clearly see how it trades the market. We have compression stops and different exit strategies, holding periods involved, and you can see exactly some of the trades. Now, first and foremost, this trade gets in, it gets stopped out, get in, stopped out, got in, made back money, and then what did it do? Traded out on a compression exit. Again, jumps right back in, and when you look at these trades, what would float your boat? Getting short when the volume is starting to move lower, and that's what this volume tool helps traders to digest. Should we be getting short the market when the volume is more positive? And it may help you to filter out better trades. So the moral of the story is volume is an integral part of the market, and I firmly believe that volume is the lifeblood of the market still, but somehow there's a decoupling or detachment from how on-balance volume used to work as well as it did in the past, and how it's not working as well now. So I'm saying, as we are in 2020, a new era of computerized trading has taken over, and ways to offset other trades in the market rather than which may be the reason why we don't see volume working as well as it is. So it's not that I reinvented a wheel. It's just I modernized the way we look at certain measurements and rates of changes, and that's what we've created for our traders. How does this work for even Forex? In our live trading community, months and months ago, I said, gang, there's just the ATR, average true range, or the daily range expansion in the British pound is next to nothing. It's hard to trade. And we have a better or a higher degree of average true range in the pound relative to the euro currency. So we enacted a model here on the British pound. And I mean, quite frankly, this is pretty wild. If you think about it, the moves that we're going through, it's like nothing going on compared to the equity markets. But this, again, is a model that only trades certain times of the day. And as you can see, it's captured some pretty good shorts, some pretty good longs. It's captured a little short here that lost money. It regains its value and makes back that loss. It gets back on the short side, has a great day. And then today, I mean, it just captured almost every major swing in the market. So if you look at the way the volume trend is, taking shorts when the volume trend is going down, it will help to maybe add value to what we do in our live trading room and add value to those that are trying to trade more successfully. And I got to tell you, this is not this is by no means an easy market. And I think the increased volatility, and when I say it's not an easy market, friends, you know, we had with today's action nearly 90 point move, in 5 minutes when the Federal Reserve announced that half point rate cut. So again, any trading model is going to change when you have an enormous amount of changes with the way it trades. I said that was a 100 or 90 point move in 5 minutes. We saw many times they're passing out 10 point, 20 point swings every 20, 30 minutes in this market. The 10-day average true range in a normal 5-year period is around 26 S&P points for the day, not for the 15, 20 minutes. So it is a very unique environment that we're trading in. All right, lastly, I just wanted to tell you, I said I would share some of the format strategies here on the gold model that we have, and it's just you'll see here, start time is 7 a.m. Add minutes to start time is 115 minutes. So you'll notice that's, 120 minutes is 2 hours. So that's 8:55 starts to trade. It only takes signal at 8:55. You'll notice here end time says 14:25 minus 10 minutes. That means it takes no new trades past 2:15. 10 minutes from, if you subtract 10 minutes off of 14:25, you got 14:15, right? That's 2:15 in the afternoon. That's why you don't see any new trades. It will exit any trade at the end of the day. Exit end of the day. And these are part of the criteria, and we can optimize our time frame, the best time to trade within any time frame, or let it run. Our exit strategy trails a stop when it's 40. I don't want to go through all the explanation here, but here's a model that maximum trade loss is $290. So it won't take any trade, or it'll get you out if your max trade loss exceeds $290. Max take profit, it'll bounce you out of this trade. On this, again, is a 5-minute day trade model at $900. And then it'll trail the stop, and that's what this does. The compression exit is the one function that is the overriding factor on the 50%. So it gets you out of the trade on half, and it trails the stop on the balance using my compression exit formula. I just wanted to at least emphasize, what does it take to make money in this market? Sometimes you need to be a little bit diversified in trading other markets, and I think that's why we have so much success around here, is the fact that we do offer different trading models and markets, rather than try to just trade one market all the time in somewhat which can be, for low traded accounts or people with small accounts, impossible market conditions. And so with that said, I thank you very much, Jim, for your comments and your insights on how you utilize and have found success using our indicators. Thanks again, everyone, for listening, and I hope you found this video helpful, as well as the ones that we'll do in the future as well. Thank you.